Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's on November 1st, and we're joined by Marc Lorin of Coquest. Last week, we spoke with Mike Locke of Coquest, and he was talking to us about the different hurdles and different things you got to go through to really take your business to the next level, from just investing your own assets or your family assets to really starting to look to take outside capital. They're really Coquest manages and tracks a lot of different CTAs, has been in the industry for decades, and has tons of experience with the business side of managing, running, and performing a CTA. And so we're going to speak with Marc today about a lot of different questions regarding CTAs. How's it going, Marc?
It's going well, Mike. Thank you for hosting this event.
Yeah, absolutely. So, like I said before, we spoke with Mike last week, and we spoke more about the how to take your business to the next level, all the different hurdles that the more institutional investors are going to be looking for. And so, what I wanted to speak to you about today, though, is more about the CTAs themselves. What's been performing well, what hasn't been performing well, what investors have been looking for, what investors have not been, what has been unloved, and what you think is going to be happening in 2019. So I guess
Sure.
let's start out with. I mean, tell me a little bit about I guess CoQuest and how you deal with and your experience with a lot of different CTAs.
So CoQuest Advisors, we basically provide investment management consulting services for investors, where we build bespoke portfolios for these investors. We deal with, call it top tier retail or bottom tier institutional types of clients. And we can basically implement the portfolios various ways through fund investments, through managed account platform, or directly through managed accounts.
Right. And how long has CoQuest been around for?
So CoQuest itself, the company is about 20 years old, started as a energy brokerage firm down in Dallas, basically servicing oil and gas producers looking to hedge their production. 3 years ago, it decided to expand on its fledgling investment management business by hiring a team coming from Altegris, which brought some of the private wealth business that was housed at Altegris then.
Nice. And so right now, how many CTAs would you say you guys track at the moment?
We track about 80 CTAs or 80 programs, I should say. That's probably, I don't know, 70, 75 CTAs, something of the sort. So we track them through our risk management system. We track their daily performance and their daily risk.
Gotcha. And what the CTA landscape has changed a lot in the past 10, 15 years. You've been in the industry, I know, for a long time. What would you say? Tell me about that, I guess, the change that you've seen over the past 10, 15 years in the CTA world and what people are doing now.
Sure. So looking at institutional investors, the broad trend for the last 10 to 15 years has been a very high level, at a very high level, has been a greater adoption of alternatives in institutional portfolios. And I mean, we see this very visibly with the endowment portfolios, where you look at the largest endowments and they follow the Harvard Yale model, which limits allocation to traditional long only assets and instead have an emphasis on alternatives, especially absolute returns and private equity debt. On the other side of the spectrum, you got the smallest endowments, which have much more traditional allocations towards long-only assets like equities, fixed income, and real assets. So on the institutional side, the implementation of managed futures mandates as overlays instead of fully funded investments has been the trend. So, for example, via managed accounts, you can control a $500 million allocation to manage futures at a, let's say, 10% volatility level with only a $10 million cash commitment. So as such, these overlays do not need to provide a return during good times for risk on assets. If what the investor is looking for is not to lose any money, but instead what they focus on is providing that risk mitigation component, that when there is going to be a prolonged bear market or a tough time for risk on assets, the portfolio, the managed futures portfolio, should do well. This has created a lot of demand for managed account platforms, which has seen tremendous growth in the past 5 years. Looking at the retail investors, well, we've had low uptake in the last few years. That's mostly driven by the lack of performance versus risk on assets like equities. Retail investors tend to gravitate naturally toward the shiniest of assets. Might also be due to the fact that of the barrier of entries are high in the mutual fund world due to the lack of proper guidance from the SEC with regards to leverage, which managed futures strategies employ. The rules against charging incentive fees is not really motivating a lot of managers to start mutual funds. And then obsolete IRS taxation rules for income derived from commodities for mutual funds. What that's doing is on the retail side, it's leaving us with poor choices or of either complicated structures that can add several layers of fees, which don't benefit the investors, or a diluted return stream that's not very attractive. So that's on the investor side. From the manager's perspective, what we've seen is that assets in the overall managed futures space are growing, but it's going to the largest firms. So assets, AUM industry-wide are said to be around $350 billion. When you remove the 10 largest firms from this AUM and you look at the growth in the last 10 years, what you're seeing is that the growth for the smaller managers has actually been negative, which has been hurting the smaller managers.
What do you define as a smaller manager?
You know, in our space, you'll consider managers larger than $1 billion. The larger managers, call them 500 to $1 billion, or the medium-sized manager. Anything else is, well, 250 to $1 billion is the medium size, and then less than 250 are the smaller managers.
Wow, so you would consider even somebody who has 100 million as a small CTA?
Nowadays, you do, yes. I mean, actually, the regulatory environment is raising the barrier of entry. There's actually a survey that Citibank did in 2013 that puts the break-even AUM for a hedge fund manager at 300 million. For managed futures, I think it's lower, but I would say a manager that was making money at 50 million 10 years ago, today probably needs to have 150 to 200 million to find that same break even.
Yeah, I mean, there's definitely added legal, administrative, compliance costs. I'm not so sure on that number, though, other than the fact that, what they also might be factoring in is, okay, to kind of get those assets and kind of be respected, you kind of need a number of different people at the firm, which, then you're starting to get to the salaries, the overhead, things of that nature. But, if you have a 3-person shop, I guess also the fees have come down, though, is the other part of that.
Well, I can mention, I can talk about that in a second. But I mean, just looking at the size of AUM at the firm, in order to go and get the larger mandates, let's call it, the 20, 50, $100 million mandates, you need to check all the boxes in terms of due diligence, right? So that means having, like you said, a proper CFO, a proper COO, proper compliance person, etc. And these are expensive. So these, for the smaller managers, with the fee compression that we are seeing, it's putting the bar quite high, in terms of what AUM they need to break even. So I don't really believe in that $300 million either. But at the same time, I know that firms that are less than $250, $300 million have a tough time building the infrastructure that they need to build in order to go and compete for these larger mandates.
Yeah.
And then, the pressure on fees. I mean, investors have been seeking a greater alignment of interest with the managers. So the standard 2 and 20 model is no longer standard. And we're seeing new ideas now, like UTIMCO's 1 or 30 model.
Explain that. What's that?
Well, so in a typical 2 and 20 model, the manager would charge a 2% annual management fee, and then would also take 20% of the profits.
Right.
But UTIMCO's model of 1 or 30, they will charge 1%. They will pay 1% management fee annually, or up to 30% of the profits. whichever one is the greater. So what that does is really aligning the investor and the manager in a much greater degree. It's giving the manager the 1% that he needs, management fee that he needs to run the business on a yearly basis. It pays the bills, it pays rent, it pays the lights, etc. But then it gives them some upside once they get past a hurdle, that 1% that they're already collecting.
Yeah. What other interesting fee structures? Because yes, 10 years ago, 2 and 20 was what you read about in the papers, and a lot of people were charging. Then, there's a lot of 0 and 30 sort of structures where it's zero management fee, but a higher incentive fee. So that's one other way of saying people are more aligned from that perspective. And then I'm also hearing more of like, 0.8, like, so less than 1% and 15. What is your sense of the general landscape? So if somebody was starting a fund today that has a 10 vol, trading the markets, whether it be systematically or discretionary, what sort of fee structure might they be looking at?
They're probably going to look at, we see some of everything, right? I mean, the 0 and 30 was popular for a while. The problem with the 0 and 30 is that in the case of a prolonged period without any performance, the CTA, the manager doesn't have really the money to the operating capital to run the firm, and that presents a problem, right?
Mm-hmm.
Hence the 1 or 30 model seems to be a bit of better model. The traditional 2 and 20, I would say, yeah, I mean, it's probably gone down to more like of a 1 and 17 on average, or slightly over 1 and around 17 is, and it's still very much the prevalent model that we're seeing out there. And we've seen a few 0 and 30.
Interesting. Okay, so that's the fee side. So let's get
But
into.
well, actually, on fees, Mike. I mean, if you talk, the fee pressures have also kind of caused more pressure on the industry, where what we've seen is more kind of what used to be called alpha products to beta products now. The retail side, for example, where mutual funds have a difficult time paying for incentive fees, well, the result is that they get a more like what's called a better replication product.
Explain on that. What do you mean by that?
So what is being called a so-called alpha product is a fully researched product, right? Where the manager is employing his best systems, his best risk management techniques, etc. But there's been a lot of demand because of pressure on fees for products that do not carry even a 1 in 15 type of fee, but more of a basis points type of fee, very much more similar than what you're seeing in the mutual fund space, right? So we're talking about fees of 50 basis points or 75 basis points annually or something of the sort, just the management fee portion of it. And so that's causing some of the managers to come up with programs where they're not offering their most researched product. They're offering a more basic version, kind of a watered down version of their product in terms of research. It's 10 years ago, it would have been considered a very good product. In today's world, where there's been some progress done in terms of research, it's kind of considered less, or an average product, if you will.
Yeah. Let's get into what sort of strategies have been attracting assets. Now, you started out, you already mentioned the larger funds are attracting assets, but is there a specific strategy, whether it be trend follower, counter trend, systematic, discretionary, any sort of segments that more recently over the last year are picking up steam and attracting interest from investors?
Sure. Well, on a gross dollar basis, it's probably trend following that's attracting the most assets. It's the largest sub strategy in managed futures. It represents about half of the assets under management. In the last couple of years, we've seen some large mandates from institutional investors talking of hundreds, even billions of dollars of assets. These mandates are very large mandates. Because trend following offers that divergent return profile which institutional investors seek, and makes it a good diversifier in a risk on assets portfolio. In terms of market share, it is probably quant micro strategies So trend following strategies use only price-based inputs and are therefore reactive in nature, whereas quant macro strategies add fundamental data as inputs, which potentially makes them more anticipatory in nature. And that's what these investors have been seeking.
And is there, it seems like there's always new strategies, always new kind of programs. What are some new interesting kind of trends that you're seeing from that side?
Um, so I wouldn't call them new strategies, but what we've seen also recently is some risk premium strategies like carry, premium selling, term structure, relative value, which have a tendency to do well when mixed in a portfolio with trend following. Just because trend following, there's a bit of that optionality that the cost of that theta for having that divergent profile that actually risk premium strategies help pay for that premium or pay for that premium. That's kind of the idea in creating a more an all weather portfolio. And then we're seeing the buzzwords recently has been artificial intelligence, machine learning,
Yep.
etc. Where some of the strategies are employing truly complex systems akin to weather predicting algorithms, and others are much more simplistic, are using machine learning as a more efficient optimizer. Um, yeah, it's there's some of everything. And I think almost the term is being overused because a simple regression analysis uses some form of artificial intelligence.
Yeah. What tell me about trend followers. They seem to be underperforming this year. Uh, where do they stand, and how has the industry changed for trend followers?
Well, trend followers are having a tough time because they need two components um, to perform well. They need one, a higher level of volatility. So if you look at CTA returns, when the VIX is above 20, they do well. When the VIX is below 17, they have tendency to do not as well. And then they need a low degree of correlation between the markets. Um, so definitely the low volatility environment that we've been in since the start of QE has not helped CTAs. And then the bouts of volatility spikes that we got in February and just in October also have a tendency to hurt them because CTAs are not long volatility like a lot of people will say. They actually their profile is being more trying to replicate a long gamma profile. And so when the markets turn suddenly, all of a sudden, they end up their positions end up not doing well in the initial turnaround. It takes them a little bit of time. It takes a little time for their book of positions to adjust to the new environment, and then they start doing well. So when you're looking at CTA, you shouldn't look at CTAs over a day, a week, or a month. You look at CTAs on a quarterly or yearly basis in terms of their returns to be able to kind of find that risk mitigation component or crisis alpha.
Yeah. Well, I know they've changed a lot and optimized a lot, and that's part of some of the systematic, and that's what makes some of them better than the others is the way that they can optimize. But even getting back to like the turtle tradings of like let's say John Henry, he was one of the most successful CTAs for years, and then almost for about a decade underperformed. Um, it's it seems like there are just so many people doing very very similar things, and that's part of as well what's affecting a lot of the markets. And even on that, actually one of our subscribers actually just put something in the chat saying that paraphrasing because it was a long one, something right now investors looking for delusional risk reward demands for small startup managers make it really difficult, and just a lot of different people trying to do the same sort of things. He's actually pointing to a lot of people maybe moving away from the CTA method and moving to more family offices where it's less stringent on the risk, day-to-day risk, and month-to-month risk, that sort of thing.
Sure, but I think what's being lost with CTAs is the fact that CTAs are not all about trend following, right? It's
Sure.
about other types of strategies, that we have. You can call them whatever, technical diversifiers, whatever. But and it's where the opportunities are, and we view this as an opportunity at Coquest, in the sense that what um, what we've seen is a retrenchment towards the largest investors, the largest managers, and the largest service providers. And so every time you talk about the largest managers, there's a huge component of trend following in their portfolio. And then they are so big that actually they cannot trade the smallest of the markets. They can't trade orange juice, they can't trade cotton, they can't trade all these diversifiers in their portfolio, and end up going to the contracts that are liquid enough, to really handle their trades, right? Their trading.
Yeah.
So they have a tendency to trade more fixed income, equities, currencies, more the financial side of things and less the commodities. And so you end up with a portfolio that's much less diversified because all these financial contracts have a tendency to correlate to each other a lot more.
Yeah.
The opportunity set to the smaller managers is actually much greater because they can diversify across many more contracts, just because each of the contract can move the needle, really move the needle for them. And so that's point number one. So point number two is the fact that these other managers are employing very different techniques, could be, doing something very special, very specialist orientation in the market, like, just trading energy, for example, or even just power within energy. So there's many more opportunities to discover CTAs in the marketplace, and you should not focus just on the large one and what's happening with the large one.
So
And
what's
then,
Coquest? Oh, I'm sorry. Keep going.
to your point, that there's a lot of AUMs in the space all doing the same thing at the same time, et cetera, in the market. When I said there's $350 billion of AUM, actually, this is the stuff that we see, right? That we're aware of. But the pressure on fees have caused actually the largest of investors to start their own program in-house. You're talking about the largest investors like the ADIAs, the OTPPs, the CalPERS of the world, who can hire the staff to run an in-house program. And so they design them, and so these programs are in the market every day, but we're not really aware of what they're doing because we don't see them they're not being reported into any type of database, etc., where you kind of see what type of AUM they're running.
That's an interesting point. And yeah, I know that the trend, certain firms are benchmarking in a way what a typical trend follower might do, a long-term, short-term, and so you might be missing out on a specialized few basis points based off of an individual firm's tweaking of certain signals, but they know within certain hours or days or levels that a trend follower wants to get in crude at this level or out of crude at this level, and so they're in a way taking down fees and just kind of creating a beta sort of index, that sort of thing as well. And so it makes sense, like you're saying, a CalPERS possibly just doing that on their own as well.
Right.
Yeah. So at Coquest, you guys invest in a lot of different CTAs, track a lot of different CTAs. What are you guys looking at as we approach 2019 as strategies that you think are going to do well in 2019?
Well, tell me what the markets are going to be doing. Are we in for continued?
Oh, that's easy. I'll tell you that one.
Or are the markets going to bounce back and we're going to go back to the same environment we've seen in the last few months? That's largely going to be determining what's going to happen. So if we're in for some type of bear market that continues, I would tell you that trend following is probably going to do quite well. I would imagine commodity traders would do well. They've done fairly well in 2018. It's been one of the brightest spots. There's been several opportunities, or there's been opportunities in several markets this year, like energies, industrial commodities, industrial metals, and that's going to be probably continuing, is my guess. We don't look much at volatility because we have a tendency to shy away from option strategies. But volatility trading, I would imagine, would continue to do well if the volatility environment stays where it is. And then discretionary macro, right? I mean, when we are in an environment where things are changing and capital flows are changing, this is where discretionary macros are going to be able to anticipate these capital flows and take advantage of them. And then trend followers will also catch them, but they're going to catch them at a later stage of the flows.
Yeah, well, I'm looking right now at the SG, I guess CTA index sort of performance, which is updated with a few day lag, so I don't have full month-to-date information, but it says as of October 30th, whether it be the CTA index, the trend index, the trend indicator, short-term index, it was an ugly month for those sort of indices. And those are a broader basket of kind of how CTAs have done. And they're down roughly 3%, and year-to-date now down like between 6 and 8%, that kind of basket.
Right, and then you see, though, the managers have done quite well, because, in fact, in the sense that when you compare the trend indicator with the trend index, the indicator representing the market opportunities, really, that index is down.
Yeah, 17%.
17%, something like that, exactly. Whereas the trend index is down 8%. So obviously the managers are able, through their risk management system, at really mitigating the lack of opportunities and being chopped up. Is the way to interpret that.
Yeah, that's an interesting point. I hadn't looked at that. I was actually going to ask you about that, what exactly that is, because that one is the big outlier, but everything else is down 6 and 8. At Coquest, what is the smallest size CTA that you would take a look at?
Very small. I mean, hundreds of thousands of dollars of AUM. We actually like to discover managers very early on, and we like to be able to help them build their business. We welcome and want to help new entrants. We really want to help service these smaller managers, and this is why we've actually started the CTA challenge, the Coquest CTA challenge, about 5 years ago, which really was originally meant to discover new CTAs.
Yeah, so tell me a little bit more. Mike spoke a little bit about it last week. I just actually brought up the homepage for that, which is ctachallenge.com, and you can find out more information about it there. Marc and he's been telling me about it for a few weeks now, and it sounds really interesting. Where, Marc, you tell him about it, you'll be able to tell him much better than I will.
Well, if Mike is around, I'd like him to talk about it. Are you on, Mike?
Yeah, I'm here. Can you guys hear me?
Yeah, you sound good. So I have a chart up right now. Welcome, this is Mike Locke from Coquest. I have the homepage up for the CTA challenge, and we're just kind of getting into that. I guess tell me a little bit more about how it, you've been running it for a few years now, and how do you enter, and how do you keep track of everything?
Okay. Yeah, the CTA challenge, we started back in 2013. So we're completing our 6th year. We're doing signups for a 7th year. So it's a full calendar year. We do an evaluation of a large basket of CTA programs. Entering the CTA challenge, we're in sign up period right now. It's limited to registered CTAs. So unfortunately, we can't take people that just want to enter their proprietary trading program if they're trading from home. But once they flip the switch and form the CTA company and get registered with the NFA, then we can look to enter them into the challenge. The requirements are relatively low. We want an account that trades about 100,000 trading level or larger. There's no really restriction on markets other than they have to be futures markets only. So we can't.
Okay, so no FX.
No, yeah, we steer away from FX, and we definitely can't do equities or anything like that. So this is for registered CTAs doing managed futures programs. Preferably in a managed account format, but we have ways to track folks that do things through a fund vehicle as well. I mean, it still boils down to a trading account. So for us, really, our goal is to get all the risk metrics and performance metrics And we really want to see the nuts and bolts of what the CTA is doing. And we do stress testing, well, sort of similar to stress testing. We do a VAR analysis and an expected shortfall analysis on top of looking at your rate of return and your margin usage, and Sharpe ratio, Sortino, things like that. So we do kind of the best we can, a full gamut of quantitative review through the CTA challenge on an automated basis. On top of that, we throw in a qualitative review, which is where Coquest Advisors comes in, our research and advisory division. And that goes down to actual due diligence reviews and phone calls and strategy reviews with the manager themselves. CT is that, we track the performance and we make sure that we have a full file and kind of understanding what they're supposed to be doing through these qualitative calls. The CTAs, they trade their live account throughout the year that we're tracking. We're getting statements directly from the broker, so there's no chance for the trader or the customer to fudge things. We get unedited information directly from a broker statement. After the end of the year, we run all the numbers through the gamut, and we cross-check everything and then double-check that we haven't made any clerical errors, and we announce winners. Usually top 5 guys go right to our Coquest Advisors for full review and consideration for going to what's called a recommended list, which that's usually where our allocations are sent to that list. Coquest as a whole, we oversee about 1.5 billion in assets directly, as well as we've got, we're able to control and direct assets from other sources where we are not necessarily the broker record or the advisor on, but we have consulting agreements, and we also just have friends in the industry who watch the CTA challenge and use it as their own buy list. These would be our competitors and other peers, other broker teams or investors. So there's a bunch of money watching to see who's going to win the challenge each year.
Yeah, that's and in the past few years, you've seen money flow to some of the top 5 or so, right?
Oh, absolutely. Back in our 2017 CTA challenge, we had about 26 million that we raised directly that I can actually quantify because I helped those new account paperwork and I know exactly what allocations went out. And that went to 7 of the top 10 performers for the year.
Wow.
And that was just Coquest directed. Now, and we also heard plenty of stories of other managers that were in the top ranks where the CTA challenge helped get some of their potential investors over the hump. We were basically a third-party verification of the quality. It wasn't just a CTA trying to sell or pitch his product to an investor. It's really, we came in as a, kind of flanked that investor from the side and really helped get them over the hump and see that allocation hit the books for the CTA. And you can't really quantify that, but the numbers I've seen is anywhere, it's anywhere from 5 to 25 or more million each year. Because we do get, we have plenty of conversations with other brokers in the industry. They thank us for the efforts because we're doing a solid for the industry. We provide the CTA challenge and we make the results public. We're not trying to covet it just for our own research. We want it to be public so the CTAs benefit off it.
I'm just going to ask you this. Somebody's asking, a subscriber's asking, does the website disclose what strategy a manager is utilizing? If so, how specific is the public disclosure?
Well, you go to the CTAchallenge.com website. You can go right on the homepage. There's a link for the 2018 participants. And there's a list of everybody. It gives the CTA name, the program name. It gives an overview of the strategy. So, if they're systematic or discretionary, whether they're diversified or single market, whether they're trend following or sector specialists or, a multi-strategy, whatever. You can then go ahead and click on that CTA's name, and it's going to bring you kind of a little more robust list that we have.
Yeah.
That actually routes you away from the CTA Challenge website, because now you get into official like Coquest Advisors and what's called a Coquest Traders Research. It's a subset of Coquest Advisors. It's essentially our research database on CTAs that's also publicly available. And you click through on the CTA names. Once you get to that CTA Challenge list on our Coquest Traders Research page, you can click on any one of them and you get the entire tear sheet. with lengthy program descriptions. You got manager bios on there, historical returns of the program. It's everything an investor could ever want to know, or anyone doing due diligence on a manager. It's about as much as we're really allowed to show you publicly. So there's a lot of information there too. So to answer that person's question, yes, you have to click through a little bit. The only reason we have to separate church and state from a regulatory standpoint, we can't show performance on the CTA Challenge website, but you can click through and get auto-routed to the other places, and you can be sure you're going to find what you're looking for.
Right. And then in terms of seeing any sort of exposures on how people are positioned, you don't have that information, and you don't provide. Well, you don't provide that information.
No. I mean, there's the verbal descriptions that you can click through on the sites, but when it comes to actual positions on a day-to-day, no, we're not going to give away the that's the manager's, it's their poker hand. We're not going to show it to anybody.
Sure.
That's their proprietary information. We've got non-disclosures that we're not going to reveal any of that.
Right. And so I'm on the main site right now, and it shows the current 20 rankings September. How did those top 5 that I'm looking at fare ballpark in October?
We're still calculating that. I finished. I do about, I want to say about 95% of the calculations, and I finished half of it this morning. I've sent off to, we've got a risk analysis group that does our full VAR analysis and expected shortfall analysis. They have a subset of processes they need to do over the next 48 hours. When I get their responses, I'll be able to publish or actually answer that question. So probably Monday or Tuesday, I'll have a little better idea where the rankings are. Right now, all I can see is performance numbers, but I can't see when we do our risk-adjusted rankings. Everything changes once we stress test it all.
Yeah.
So I can tell you that October was a tough month for a lot of guys. We had a few up double digits, which is great. But I'd say 2/3 of the participants were down in the month of October. Some down pretty big, which was, it's tough to see. After what happened in the equity markets, we would like to see, as kind of Marc led to earlier, we'd like to see divergence away, the non-correlation. But unfortunately, a lot of the larger managers that are trading financials, they are slightly correlated to equities, and they had a poor month.
Yeah, well, I think, and you can speak on this, but I think it was the combination of equities. A lot of people had long positions in oil. A lot of people had long positions in, and both those had sharp reversals. And fixed income as well. There were some positions in there. While it wasn't as aggressive of a move, it was away from what the positions were. So things like that. And then the FX really didn't do a whole lot.
Yeah, correct. The thing we like best about CTA Challenge, like we'd like to do it for longer periods of time to get to see participation of these programs through multiple market shocks. But for sake of making it a realistic program, we put it at just 12 months. So any single month is not going to make or break a CTA in the CTA Challenge. Any single quarter is not going to make or break it. It's really the full year that we're going to analyze you. So you have ability to kind of make up where you lost in 1 month. And as well as what we saw like in January, February, a lot of guys had incredibly positive performance in January and then gave it all back in the first week of February. So we do say both sides of it, but when you spread it over a 12-month period, we get a much cleaner view of what you're going to be like throughout a handful of market scenarios.
Yeah. All right. Well, Mike and Marc, thank you very much for talking about CTA world, giving us a little bit more of an insight into what's going on over there, the trends into where assets are going, what people are doing. We really appreciate it.
Our pleasure, Mike. It's been fun.
All right.
Yeah, thank you, Mike.
Sounds good. And I'll have more information. If you want information on the CTA Challenge, that'll be in an email, and I also posted in the chat room. So, if you guys have any questions, let me know, and you can contact Mike or Marc directly as well. But thanks a lot, guys. We'll talk to you soon.